Hey, what's up, everybody? I wanted to talk about what Scott Bessent said on his NBC interview. I want to talk about what people will be watching for this busy week ahead. I want to look at some stocks, where they open for after hours trading today at 7 p.m. Central Time. So we're a couple minutes late, but this is technically pre-market of pre-market because technically the stock market's not open right now, but you're able to see how they start trading today. We'll also look at some market caps just to kind of start imagining stuff together. I think today will be pretty fun. Hope you enjoy and be on the lookout for the next videos. So let's get into it. So first, stocks. It looks like we got some moves so far. We got a little green candle. We kind of sold off into the close on Friday. There was some different news going on, and then Moody's downgrade came out, downgrading US credit down one notch. So of course the market seen that as scary news and kind of sold off, and it looks like we're starting on a green candle, and this could be from a few different things. I think the main one was Treasury Secretary Scott Bessent's talk about Moody's being a lagging indicator. It's not really a big deal, and said they haven't really did this in just 100 days, right? They acquired this and blamed Biden for government spending and where national debt is, for him not doing his fair share to keep it down. Really just scapegoatism. Him just playing the blame game. Hey, it's not our fault. It was their fault. See, it's not that bad. And he kind of implied that everybody was implying for this to happen. Moody's was the third large credit agency to downgrade U.S. credit debt. So really, he didn't think it was a big idea. Then he also said that he talked to the CEO of Walmart, and out of that phone call, he wanted to hear it from the CEO himself. Like, he wanted to hear it from the horse's mouth. Are you going to be raising prices on consumers? What he said is he verified it. He didn't put any pressure for them to do it or not do it. He just wanted to hear whether or not it was true. And Walmart did double down and say, yes, we're going to be raising prices. We're going to try to eat some of the costs, but we're only going to be able to do so much. And consumers will also be sharing that with them. Who knows who eats more of the tariffs out of the two, but consumers will be impacted by these raising prices from Walmart. They also mentioned that gasoline costs have plummeted, so that's really what everybody's focus was on. So it's like, yeah, gasoline prices are down, so you're doing pretty good right now. That's what y'all wanted, and that's what y'all got. But between me and you, we're going to be raising costs in the store. And in a way, they kind of justify that. So that was interesting. And then he also gave more insight into the talks between the US and China as far as trade talks and tariffs. And he said that neither side backed down. Rather, they seen the situation as being unrealistic long term, and maybe they were just trying to stand their ground and didn't want to back down, but that couldn't last forever. So where we're at are more realistic levels. Yes, the tariffs percentages for all of the countries, they're at 10% right now, and China's at the 10% plus the 20%. They can go up from here. This is just the baseline. This is where they're starting. And he also mentioned that they're going to be sending out the letters to the 150 countries that they don't have time to meet with, and let them know where we're going to start, where we're at as far as tariffs. Now, as far as the markets, I mean, it seems to be kind of okay. But a lot of people's starting to get scared of the market again, especially the stock market. There's a ton of different asset markets out there. And we'll look at market caps of some of these different asset buckets a little later in this video. But people are starting to get worried about stocks in general, and especially these US stocks, just because I seen this acronym earlier, and it was talking about how the acronym was Anywhere But America Assets or something like that. And it was pretty funny, and it's like this meme of, let's get away from the US, let's get out of the US dollar, and let's look elsewhere. Just because there's been quite the run, the president's pretty wild in the office. We don't know what's going to happen out of that. These tariffs, consumer spending, all of these other countries are cutting rates. There's a lot of different factors that's playing into this, and it's causing people to really think about it. is this worth it? So then today on Wall Street Journal, well, yesterday, they came out with this article. Sam Goldfarb, I think I'm saying that right. Just how expensive are stocks after all the ups and downs? We checked the math, and some of the things they mention is that the stock market could be seen as overvalued just for a couple different reasons. They first talk about price to earnings ratio. The most common applications of this metric compare stock prices with the company's past 12 months of corporate earnings, analyst expectations for its next 12 month of earnings, or so-called cyclically adjusted earnings, the average annual earnings of the past 10 years adjusted for inflation. And when they looked at it, they said that when the whole S&P 500 is looked at, all three currently show investors paying a high price for every dollar of earnings compared with what they have paid in the past. So they're saying, according to all three of these PE, price to earnings ratios, by different earnings calculations, cyclically adjusted, past 12 months, next 12 months, investors are overpaying or paying a lot higher levels than they have in the past. And just to further dive into this, because I've heard of price to earnings ratio before, but I've never heard of these different ways of it being measured. So I wanted to look more into that. So here's the ChatGPT conversation I had just asking about it. And for cyclically adjusted PE, and they say CAPE or Shiller PE is what it's referred to as sometimes, it takes the price of the stock and divides it by 10-year average of inflation adjusted earnings. And the purpose of this smooths out short-term fluctuations in earnings caused by business cycles, and it's used for long-term valuations of markets. So in the long term, they're saying, yeah, you're paying a high price for long-term valuations of the markets, and especially the S&P 500. The pro that comes with this is it filters out noise from booms and recessions, but the con of this is that it's less useful for timing short-term trades. And that starts to make sense. Okay, well, if you're going to want to look at the valuation of stocks and you're going to look at price to earnings ratios, it makes sense to look at it from more of this long-term point of view. Then you got the past 12 months, the trailing PE, and this takes the price divided by earnings from the last 12 months, looks at actual reported earnings performance, and it's used for analyzing current valuation based on real numbers. A pro of this is objective and based on actual results, but the con is that it's backward looking and may not reflect future performance or sudden changes. So this trailing PE looks at the past. Makes sense. Now the forward PE, this makes sense. Next 12 months, this is more future looking. It takes the price divided by projected earnings for the next 12 months. It's based on analyst expectations or company guidance. It's evaluating how cheap or expensive a stock is relative to its expected growth. The pro is that it's forward looking, better for growth stocks or if earnings are rising fast. The con, though, on the opposite end is that it's based on estimates which can be wrong or overly optimistic or pessimistic. And back to this article, it's saying that for the price to earnings ratio for each of these, investors are paying a high price for every dollar of earnings compared with what they have in the past. Then it also brings up the earnings yield versus the treasury yield. So Wall Street analysts often like to flip the price to earnings ratio upside down, creating an earnings to price ratio, known as the earnings yield. It is expressed as a percentage and sometimes used as a rough guide to the annual return that investors can expect over an extended period of time. Investors can then compare stocks' earnings yields with yields on U.S. Treasuries. That offers a sense of how much investors are being compensated to hold in riskier investments over ultra-safe government bonds. Because back to what we always talk about, what are the odds the U.S. government doesn't pay you back? They could just print the money. Now, yeah, that might devalue the dollar a little bit or cause inflation or whatnot, but you're going to get paid back, right? It's just, does it hold its purchasing value? But it's a guaranteed return at the same time. So based on real cyclically adjusted earnings, the S&P 500's earnings yield is currently around 2.8% or 1.4 percentage points above the inflation adjusted 10-year treasury yield. according to data from the economist Robert Shiller. That gap, sometimes known as the excess CAPE yield, is well below its historical average, suggesting investors are so eager to buy stocks that they are willing to accept a smaller premium for the risk of losses. So this is saying that, in my opinion, what this is saying is that people are getting FOMO and fear of missing out from this yield. The president's saying, oh, the stock market's going to do the best it's ever done. You better buy stocks. Doing all of that stuff. And then people's like, ah, man, I don't want to miss out. And my friends and my other friends that buy stocks, they're making a lot of money in the stock market. Like, look, it's just been going up. So then people are, just to be part of the wagon, so to say, they're accepting smaller premiums for the risk of losses, which, depending on how you look at it, could be much higher, and especially if you're paying a higher price for every dollar of earnings compared with what you have in the past by good sums. But then we need to consider history, though, because this article goes on to talk about just because stocks look expensive by some of these measures, that doesn't mean there's about to be some plunge, right? And then it mentions the roaring 20s and the 1990s tech bubble, where frothy markets defied gravity for years. But it continues and says that though those rallies eventually ended, leading to years of price declines, there is, as a result, a fairly tight relationship between valuations and what stocks have historically returned over long periods, such as 10 years. Now, I just think that's interesting because it gets back to fundamentals. It's easy to get caught up in all these sexy looking technical analysis tools. Oh, I'm going to chart it and the fib this and all of this other stuff and try to guess where the stock's going. But fundamental analysis, how the company is actually valued compared to its earnings versus the stock price, that tells real numbers, and eventually the stock will fall in line with the fundamentals. Think about it. If the company's burning through all of its cash and not really making any money, that's a bad fundamental company. Well, that's a bad company fundamentally. And what happens to those? They go bankrupt and to zero. So that's just something to think about as far as stocks and them possibly being overvalued, because people are starting to think about this and they're looking for every reason to be bullish this rally. But there's a lot of cautiousness out here too, because a lot of people who, just like with, oh wow, the Qs had a nice little pop. Wow, it went from around 515 to 517. Interesting. But there's people on both sides looking for information on which way the economy is heading. And you remember, recession is what's on everybody's minds. You know, a little less so after the US-China trade talks and tariff reduction for 90 days. But remember, that's temporary and these talks are still going. Anything could happen. Now, what are people going to be watching this week? We got a few different things. We got where stocks actually open. People's going to be watching that because we got some news this weekend and they don't know which way we're going to swing, especially with the Moody's downgrade. Some people think that that could be negative in the short term, although it's noise, and then people buy the dip because they're just programmed to keep buying the dip. Nothing bad ever happened since the pandemic. You just keep on buying every dip and you do well. People are programmed to just buy the dip. So people's wondering if that's going to continue or if the market starts going to lower lows. So how stocks open is important, and where they go when they open. Then we got some Federal Reserve speakers Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, Sunday. So if you can include the week as Monday to Sunday, then we got 6 days of straight Fed speakers. The only day we got off is Saturday. So a ton of Fed speak. We also got all of this economic data sets to release. On Monday, we got US leading economic indicators. On Wednesday, we got initial jobless claims and purchase manufacturing index. Purchase managers index for goods and services, existing home sales. Then we got new home sales, We got a lot of data coming out this week. And then company earnings, we got TJ Maxx, we got Home Depot, we got Lowe's, we got Ross, we got Target. A lot of companies coming out that can give insight into different forms of the consumer out there and how they're spending money and how these companies forecast the economy to go through, and especially with tariffs. Do they forecast a recession? What are their future guidance looking like? Will they even release this information? And do they expect to raise costs due to these tariffs? A lot of people is going to be watching this. Now, I thought it was interesting. I came across this website and it shows the market caps of different assets around the world. I wish there was one for real estate on here as well, but gold 21 trillion market cap, Microsoft 3 trillion, Nvidia 3 trillion, Apple 3 trillion. I didn't realize Microsoft passed Apple and Nvidia as the most valuable company. Amazon's up there. Look at Bitcoin. Bitcoin's more valuable than Google is. 2.1 trillion market cap. Wow. Silver, almost 2 trillion. Vanguard, the total stock market ETF for this VTI stock, 1.7 trillion. Bitcoin is more than VTI in market cap. How big is Bitcoin to gold though? So gold is less than 10% in size. Wait, gold is 10% the size of I should have been able to do that, 21 to 2.1. I really had to pull out my calculator. So wow, it's not quite there just yet, but it's getting awfully close. It's crazy to see where we've came from. Tesla 1.1 trillion, Berkshire. Now let's look at VOO. So we just looked at the total stock market. VOO, wait, let's do it again. VTI, you got 1.7 trillion, 1.7 for the total stock market. For the top 500 companies, VOO, 1.3. So you go from 1.7 to 1.3. So 1.3, QQQ, NASDAQ 100. How would I do the NASDAQ for Vanguard though? Let's just see. Is there a Vanguard? 100 ETF. VGT would be what it's called. All right, that would make sense, because if we go from VOO, which is 1.3 trillion, and then if we just wanted to look at the top companies, it would make sense. So 88 billion of the 1.7 trillion. So a little under half are the top 100 US companies. Wow. What about DXY? Oh, we don't got that. All right, what about, would VIX be on here? TLT, 9 billion. I don't know. I just thought it was fun to get on here and play around and look at different market caps of these different assets, because it's easy to see the stock prices or what price a certain asset's trading at, but never actually realize how much money is actually in that asset. And that's what market cap covers or gives insight on. So y'all, this was a fun video to make. I hope you enjoyed it. We're going to be watching what happens with these stocks tomorrow at open. We just kind of talked about why there was the little pop, and now we're kind of consolidating down, and we'll be watching these levels on to tomorrow and all of next week while we got the Fed speakers talking the markets up and talking them down, and economic data and company earnings. All of this is very newsworthy, and this is an event driven market. So as things keep on coming in and keep on coming up and headlines come out, there are going to be some market moves. So everybody be safe out there. Hope you enjoy your day, enjoy the week, and I'll see you next time.